Welcome everyone to today's Business Leadership Series event brought to you by the US Pan Asian American Chamber of Commerce, which we proudly call USPAACC in partnership with Wells Fargo. And my name is Sandhya Mukkamala. I'm the partner co-founder at Astute, a CFO advisory firm, and we primarily focus on enabling companies to maintain compliance, recover lost revenues, and increase profitability, and work closely with clients to develop stronger processes and controls, help with IPO readiness, manage post-IPO compliances, accounting automation, etc. I'm also the co-president of USPAACC's Western Regional Chapter, and excited to bring you the topic for our discussion today, which is access to capital, managing cash flow. Most small business owners know the importance of this topic, as healthy cash flow is essential for operating and growing any business. In my experience as an entrepreneur and as an advisor, I have come across situations where often the liquid funds are locked up in receivables, but when you have a committed cost to take care of, this is a practical cash flow struggle that every small business owner goes through. I'm sure the fact that we are addressing this struggle today is very reassuring and imperative for our audience. Joining us today is Lauren Acera, a lead strategy and planning consultant at Wells Fargo, where he specializes in small business growth initiatives. Lauren's tenure with the bank spans 3 decades. Collective experiences in the field as a banker, manager, and coach ignited a passion for helping small business owners achieve their goals. He spent the last 20 years developing, planning, and executing growth strategies aimed at creating better experience for small business owners. He holds a degree in managerial economics from the University of California, Davis, and is a graduate of the Pacific Coast Banking School. Lauren resides in Northern California, same as me, with his family, where he enjoys volunteering at community events, running, cycling, one of my favorite sport. And Lauren would love to learn more about your cycling activities and DIY projects around the house. Welcome, Lauren.
Sandhya, nice to be here. Great to see you today. And based on both your expertise and my expertise, we've seen firsthand the importance of cash flow management and the role it plays in running a successful business, right? So today, I'm going to address all the business owners in our audience, and I'll talk about steps you can take to manage cash flow. We'll discuss ways you can help to take control of your cash flow and create safeguards to keep cash flow running positive. As you can see here, we'll primarily talk about cash flow as a key indicator of the financial health of a business. A consistent positive cash flow may help you pay expenses, invest in new opportunities, and grow your business. It's an essential part of running a business, which highlights the cash that goes both in and out of your company. And today we'll cover how cash flow works, how it's impacted by the operating cycle. We'll explore cash flow considerations during each stage of the business life cycle, and we'll share with you some suggestions on how you can take control of your cash flow and create a manageable plan. So let's dive in and talk about managing that business cash flow. First of all, it's important to note the difference between cash flow itself and managing cash flow. Cash flow is the flow of money moving in and out of a business, but managing cash flow includes the safeguards that can help ensure cash flow remains positive. We'll discuss 4 key areas of managing that cash flow today. We'll start with receiving payments. The first area here focuses on the number of payment options available and the frequency with which a business receives money into their accounts. The second area of cash flow management is making payments, which addresses how business owners may achieve better control of how and when money leaves their accounts. And as we move past making and receiving payments, we'll look into possible safeguards that may help your business maintain that positive cash flow. The third area we'll review is evaluating potential credit options that could help your business manage and supplement business cash flow. And finally, the fourth area to consider here is having a proactive plan that may help prevent potential cash flow disruptions. I'll review each key area in detail as we go through today's presentation. Now, sufficient cash flow is a key element in demonstrating your business's viability with potential lenders, but some small businesses may have poor or slow cash flow, which can be caused by anything from inadequate pricing to trouble collecting receivables. Consider these 5 tips to help you handle your business's cash flow. First off, accelerate those inflows. Send invoices immediately, follow up quickly, offer multiple payment options to help bring in the revenue. And monitor your costs. Track your regular bills and due dates. Understand how often your inventory turns and know your payroll obligations. Watch your outflows. You may consider using business credit, taking advantage of trade discounts, and even negotiating barter agreements that may help you conserve and control your own cash payments. But remember to cover your taxes. Set aside an appropriate percentage each month to help avoid penalties and make cash flow more predictable. And lastly here, challenge everything. Are you getting the maximum value for every relationship? Are there expenses you can cut without affecting your profitability?
Lauren, you've touched upon a very important piece of the cash flow puzzle, which is monitoring cost and watch your outflows. Where do you recommend businesses look when evaluating overhead cost and where they might be able to make cutbacks?
Sure. Certainly an important question. Anything from reducing the cost and efficiencies of your office space to hiring a professional like an accountant, for example, who could handle part of your finances. An investment like that in the short run can actually save you money in the long run. Just one example. Good question.
Thank you.
So we've talked about accelerating your inflows and watching your outflows. To do that, it's important to understand your business's operating cycle. Different type of businesses have different operating cycles, depending a great deal on the type of business it is or what industry you're in. Commonly, it's related to inventory, fixed asset needs, fixed costs, accounts receivable, seasonality. All these characteristics are connected to the operating cycle of the business, and different types of businesses will have different operating cycles of varying lengths. Calculating your company's operating cycle, the period of time between your initial cash outlay and the receipt of the payments, may help you understand why you're feeling cash strapped during maybe a period of intense growth. That real magic comes when you work to modify this number by pursuing more favorable terms as a buyer, seller, business partner. So this first step in the operating cycle is to purchase things like materials needed to produce the business products, acquire qualified staff available to serve customers, or systems needed to provide that service. In this step, cash is required to pay those suppliers. And then in the second step, that second step is to conduct the operations, whether it's producing your goods, storing your inventory, selling, or conducting your services. And this third step in the operating cycle is to sell goods or deliver the services, depending on the company. Cash flow can be impacted here by inventory and storage costs, as well as delivery costs. And then the last step, the fourth step in this operating cycle, is to collect payments for those goods sold or the services delivered. So for an example, a restaurant. Phase 1, purchase the food. Phase 2, produce it, maybe 1 to 2 days later. 3 and 4 come close together here when you provide the meal and collect the payment all in the same step. On the other end of the spectrum could be an attorney. So in phase 1, maybe you gain the client. Phase 2, you're working the case. Phase 3, you present the case, but you may not get to step 4, receiving full payment until there's resolution. It could be months, it could be years. So every business has its own range of time for their operating cycle. Every business is unique, like I said, but there are some common needs and characteristics based on where they stand in that life cycle of the business as it evolves from an idea into a mature company. So let's take a look at each stage of a business life cycle, different from the operating cycle. So these are the considerations you might have when it comes to cash flow. In the seed stage, the earliest stage of the business life cycle, it's mainly focused on planning. This is an ideal time to build out your business plan, develop a funding strategy. And during the startup stage, as your venture gets off the ground, securing funding is a critical priority. Investors typically prefer entrepreneurs with some skin in the game, so substantial investment of your own money can send a message that you're committed and that you want to make the business succeed. And as your business grows, your cash flow needs change. You may want to be able to take advantage of opportunities as they arise, while at the same time, you may begin to enjoy greater access to financing. During that growth stage, prioritizing saving cash up to 3 to 6 months of what you would expect to need might help you prepare for emergencies or those slow sales periods. If you plan to hire employees, just consider that you might have a higher payroll expense on the front end before you can recognize the additional revenue that those employees will bring in. Next in the cycle is maturity. Even when your business reaches maturity, your business may never stand still. While your focus at this stage might be on staying ahead of the competition, improving efficiency, continue to monitor your cash burn rate. If too much cash is outflowing, evaluate whether you still need all of these services, all of this equipment, and the full facilities that your business is using.
Lauren, it is very interesting that you mentioned negotiating terms as a way of cash flow
Mhm.
management technique. What does this negotiation look like as a business owner? What can I realistically ask for while still maintaining a positive vendor relationships?
Yeah, well, Sandhya, at face value, using suppliers with the lowest prices may seem like the best bet, but flexible payment options can be even more important than bottom shelf pricing. So, for example, asking longtime vendors and suppliers directly about setting up better payment terms could lead to more ideal timing for you as a business owner to allow you to align your payments with your cash inflows. Sometimes it's just a matter of asking.
Thank you.
You're welcome. So here, a major expansion can take your business to new places. If you have substantial cash available, you may be able to use some of it to fund that expansion. If you plan to borrow money, know that lenders will expect to see cash flow projections indicating how your increased revenues will enable you to repay that loan. And as you increase those operating costs, pay attention to your margins. You might be able to negotiate trade discounts from suppliers as the business scales up. And you begin to think about your end game, think about whether you're planning to sell the business or keep it in the family. You want to enhance its value and stability, right? At this stage, you may want to consider examining cash flow from the past 3 to 5 years, preparing those earnings projections for potential buyers, eliminating any expenses not needed for continuing operations, and factoring the tax implications of your exit and the business sale into cash flow projections. Now that we talked about business concerns during various stages of that business life cycle, let's dive deeper into the areas of cash flow and how a bank such as Wells Fargo may be able to help you address your business's financial needs, starting with making and receiving payments. Because realistically, the financial health of a stable business depends not only on strong revenue, but also optimized cash flow, where you arrange for the timely receipt of your receivables as well as the strategic payment of your expenses. Fortunately, there are some steps you can take that may help you minimize cash crunches. Managing how you make and receive payments is that first step to supporting the health and success of your business. Here are a few tips that could help you better manage payments and your cash. Accept credit and debit card payments from your customers. It may sound obvious, but you want to look for options that allow your customers to pay you on site or online or on the go. In today's environment, you'll want to offer multiple ways for your customers to pay you. Speaking of payments, take the complexity out of payroll processing. Introduce efficiencies for paying employees timely, safely, and securely, giving you more control and remaining compliant from a regulation perspective. Next, pay those bills on time, but not necessarily too early. That instinct to pay your bills immediately upon receipt shows good discipline, but it can put your business in a bind by unnecessarily tying up your cash for days at a time. By paying bills closer to when they're due, you may be able to better control your day-to-day cash flow. It's important to manage cash crunches due to expenses. It's not uncommon for businesses to run short on cash from time to time. Both significant purchases and everyday expenses can strain your cash flow. So rather than run your accounts to zero, consider turning your bank to see if your bank has any business credit options. We'll talk more about that later. Lastly, track your account balances with online and mobile banking. An account with this access can be key to a solid cash flow management strategy by helping you track your cash in the moment as it moves in and out of your account.
I like how you're addressing so many key result areas here, Lauren, which brings me to my next question about the payroll.
Sure.
Our experience in CF Advisory is that payroll expenses form a major part of the committed fixed costs that organizations incur. So, payroll is often a large and ongoing expense for businesses. So, do you have any tips for choosing an optimal payroll cycle based on revenue stream?
Choosing this cycle. Yeah. So, in terms of an optimum payroll cycle, it's going to be different for every business. One strategy is to structure the payroll to mesh with the revenue streams. So, for example, a restaurant or a retail business that brings in daily revenues can more easily cover, let's say, a weekly payroll cycle. But manufacturers and wholesalers, of course, they tend to have slower revenue streams. And so there may be an advantage to setting up a biweekly or a monthly payroll cycle. Of course, make sure you're in line with local wage laws. It's best to check with a professional on that, but hopefully that answers your question.
Great tips. Thank you so much.
All right, let's talk about evaluating credit options for a few minutes. Creating safeguards to help keep cash flow positive is the second step in maintaining a healthy cash flow. At some point in its life cycle, any business could face those cash flow issues. And really, let's face it, peace of mind matters, right? So if you have the ability to tap into credit in case anything comes up, you can concentrate more on actually running your business rather than on how you're going to cover those expenses. First up, options for working capital. Have funds available to maintain a balanced cash flow cycle and to address seasonal needs, business opportunities, or unexpected expenses. Some typical bank products, many offered by Wells Fargo, include business credit cards, a card that could help you cover everyday business expenses, or business lines of credit, allowing you to cover cash flow fluctuations. Can be ready to invest in new business opportunities with that flexible financing. Or for practices, there's Practice Finance, a line of credit or working capital term loan may be the most appropriate product. Next, capital expenditures. Credit here may help you add or replace vehicles, equipment, other finances that are other fixed assets that are on hand. You could manage your cash flow with a lump sum of cash for your business purposes like remodeling facilities, updating technology, or for vehicles and equipment. Or an SBA loan may be a good option for your business because it's known for lower down payments and providing longer terms than traditional financing. Finally, expansion. Acquire, build, or grow your business. If your business assets include commercial real estate, there are a variety of real estate financing options, including loans and lines of credit that may help you purchase, refinance, or even tap into equity.
As a small business owner, it can be very tricky to analyze, evaluate my credit options. In
Mhm.
that case, how can I establish, improve, and or sustain my business credit to ensure the best access to loans, financing, and credit options to support positive cash flow?
Topic that's probably on the top of everyone's mind. Well, it's important, Sonia, to know that before making a credit decision, a lender is going to pull reports to review both personal and business credit history. Many people may not realize they also look at personal credit history typically. So they're looking for a history of making on-time payments to creditors, and they're looking at how much debt you already have. So taking steps to improve those reports, such as paying down some existing credit or setting up automatic payments to reduce the risk of any future late payments can really be helpful. I mean, lastly, I'd say make sure the credit you're applying for matches or aligns with the business need that you have. For example, a credit card makes more sense for handling everyday business expenses, but a loan would be more aligned with an equipment purchase, for example.
Thank you for sharing that. This is really helpful, Lauren.
Absolutely. Let's move on here. We've talked about how positive cash flow is integral to growing and maintaining a business, and planning proactively can help you be prepared to take advantage of business opportunities and prepare you to confidently face the challenges that could come your way. Whether a business is just getting started or is well established, a business savings account allows you to build a dedicated source of funds to reach your goals. Using savings instead of credit is an option to plan for unexpected expenses, right? Future expansion could be for taxes. Additionally, while having a solid plan in place is vital to ensure you can retire, individuals, note that individuals who work for large employers may be set up with a predetermined retirement plan. Small business owners, though, have to select and manage their own plans, and the right plan for you will depend on several factors. Could be the number of individuals you employ, the consistency of your business's cash flow, etc. Think about the reasons for implementing a retirement plan, whether it's to prepare for your own future, to attract and retain employees, and to maintain a competitive edge, or both.
I agree completely with you, Lauren, about planning proactively. It is an approach that we all agree and want to practice, and we often recommend that our clients the same. But often we've been asked some practical problems like, how do I
Hmm.
know how much amount I should have available in my business savings account or in cash reserves?
Yeah, yeah, definitely makes sense to consider that. And there's no one right answer, but a cushion for unforeseen costs, unforeseen circumstances definitely makes sense. I mean, one rule of thumb to follow is the 10% guideline. Keeping a minimum of 10% of your business's revenues set aside in cash for a rainy day. That may make sense to most people, right? So revenues of $100,000 would equate to $10,000 in cash that's accessible just in case. Maybe that's a starting point. Comfort levels are going to vary by person, by business owner. So again, these are just directional suggestions. Definitely make sure to have cash for a rainy day.
Thank you.
Cash flow management. We know it's a critical part of your daily operations. So let's make it a part of your daily routine so you can be sure of your business's available cash at any given moment. Let's take a closer look at cash flow management strategies. It makes good sense to forecast your cash flow for the next 3 months, let's say. These forecasts can help you plan ahead and avoid trouble before it hits. The projections don't have to be perfect, but educated predictions can help you make smarter financial decisions, right? It's important to review and update your forecasts regularly. Schedule time every couple of weeks to return to your projections, update them, track the changes, add new details, stay current. Also, monitor your burn rate carefully. That burn rate is the negative cash flow or the amount you spend each month. And if your burn rate is high, you might run out of cash. You may be able to avoid this, though, by checking your cash flow statements carefully and monitoring each expense. Next, create cash flow statements every month. The relationship between your cash on hand and your burn rate is at the center of that cash flow management we've been talking about, and these elements come together in the cash flow statements. Plan ahead. Plan for cash shortages or unexpected expenses. Cash flow can vary month to month, week to week. It's especially relevant for seasonal businesses out there whose revenues fluctuate throughout the year. So you have to be prepared for shortages by creating an emergency cash fund, as we discussed a few minutes ago. So you might consider using the cash reserves or a business line of credit, or a combination of both. Incorporate useful technology. So tech tools like QuickBooks can also help you track cash flows. These services help you organize your income, organize your expenses. They can schedule your bill payments and invoice the clients all on your behalf. Lastly here, It's really important to create and regularly review foundational documents such as cash flow forecasts and cash flow statements to successfully manage your business's cash. Well, let's talk about forecasting. In less than an hour a month, you may be able to identify potential cash shortfalls or surpluses in your business's future. You can start by projecting your future cash flow for a full year. You can focus on the timing of income and expenses to identify potential gaps and estimate how deep they may be and how long they'll last.
Lauren, I think forecasting and projecting is a radical step in cash flow management. But what we often see is that collecting receivables or generating profit much slower than I have predicted. Are there any adjustments I can look at making right away to be best prepared for these fluctuations?
Yep, absolutely, Sanjay. I mean, we'll get deeper into that in the next few minutes, but I'll share a little bit here. I mean, going back to one of your earlier questions, I'd reinforce working directly with vendors. I can't emphasize that enough. Those relationships can make such a huge difference. I mean, some might be surprised that some vendors are willing to set up, let's say, a 60-day repayment plan versus the standard 30 days that may come on the invoice. But if you don't ask, you'll never know. You'll never know if they have that flexibility. So on the receiving payments end, consider offering discounts to those who pay back sooner. It's all about the timing of the inflows and outflows.
Again, great tips, Lauren. Thank you.
Yeah, sure. And back to the forecast bullets, look for patterns, look for cycles. Once you make this a regular part of your business planning, you can compare your forecasts to reality and improve their accuracy. Now that we have this broader view, ask yourself how much cash you'll need to cover potential gaps, potential challenges, because it's important to be proactive so you are ready when you do encounter an inevitable business issue. Diving deeper into creating a cash flow forecast here, before you create a cash flow projection for your business, it's important to identify your key assumptions about how cash flows in and out of the business every month. The key assumptions should relate to two primary areas. First, receivables. The assumptions should outline how quickly you typically receive payment from your customers. For example, if most of your customers pay within 30 days, the key assumption would be 90% of sales will be collected the month after the sale. And then for payables, these assumptions should outline when your payments are due. For example, if your vendors require payment within 2 weeks of delivery, a key assumption could be payables are due within 14 days of purchase. Just some guidelines.
Every enterprise, I think, thrives on this question while managing cash flow is how quickly you receive payment from your customer, which brings me to a very basic question, Lauren, what are some standard expectations that should be set in regards to how and when we collect receivables?
Yeah, I mean, typically businesses do run on a due in 30-day cycle. That does vary, though, of course, by industry, by vendor, by your local business culture. Now, collecting those receivables on time can be a challenge, right? And so one strategy could be to make sure you offer multiple payment options. It may sound obvious, some businesses don't, but consider that. Consider, rather than waiting for a paper check to come back, consider setting up a service with your bank so you can accept e-checks in the moment, debit cards, credit cards, other forms of payment to speed up that collection of receivables.
Thank you. Great tips again.
Yeah, you're welcome. All right, let's get into an actual forecast. In this example, to get started, you would create a 12-column spreadsheet representing the next 12 months. Then on the left side, list the following cash flow categories. You've got operating cash, the beginning. This is the amount of money you'll have at the very beginning of each month. And then you've got sources of cash, all the money coming in each month, receivables, collections, loans, etc. Next, you have your total sources of cash. You add the amounts in the operating cash, the beginning row, to the amounts in the sources of cash for each month. And then there's your uses of cash. List every likely expense your business may incur, such as payroll, accounts payable to vendors, rent, and loan payments. And then you have your total uses of cash, tallying up all the expenses so you can see exactly what will be going out the door each month. And the excess or deficit of cash. It's the number that counts. If you see a positive number across the board, congratulations, you may have some extra dollars to invest back in your business. But if you see a negative number in one or so of the months, don't panic. You can take some time to consider potential options to help you prepare for those months. If, on the other hand, though, you see large differences from month to month, you really need to revisit your key assumptions to check for potential gaps. And then continue to refine. To keep your projections on track, you can create a rolling 12-month plan that you update at the end of each month. And then if you add a new month to the end every time a month is complete, you can have a long-term grasp of your business's financial health and trends. Now, to get into a cash flow statement, it looks something like this. While your forecasts are designed to predict the inflows and the outflows of cash flow statements document the actual amount of income you received, and the actual expenses you paid. So it's important to track the inflows and the outflows of your business's cash so you can coordinate these purchases and payments that you need to make. Let's review how to prepare the cash flow statement. It typically consists of the following 3 sections, and it gives you an overview of the cash flow you spent toward and received from each component. So section 1, operating activities. This section summarizes the cash you earn for selling your goods and services in any given period. Include your earnings here before interest and taxes and adjustments for non-cash expenses such as depreciation. Secondly, investing activities. This section covers cash transactions related to your business's investments such as equipment, property, other major assets. For example here, profiting from renting part of your property would be a credit entry, while buying a new piece of equipment would be a debit entry. And thirdly, the financing activities. This section accounts for the external factors that affect your cash flow, such as loans and equity sales of common share of your company. If your business obtained additional financing, for example, you'd list it as a credit, and then paying off part of a loan would then be a debit. Once you've created that cash flow statement, you can use it to see how well you're handling your cash and to gauge how your cash flow may be affecting short and long-term finances. And then if you construct an analysis, you can answer your own questions such as, is my business generating consistent and sufficient cash revenue? Am I making any ill-timed purchases or payments? Am I making progress on my loan repayments? Once you've generated and analyzed cash flow statements regularly, you might notice trends that can influence you to adjust your go-forward financing strategy. Well, Sandhya, that was quite a deep dive into accounting and other concepts. And there's a lot more to know about the business of cash flow management, much more than what we had time to discuss today. So I'd like to point you and our viewers to another great resource for those interested in additional information. The Small Business Resource Center on the main Wells Fargo website. That's where you'll find valuable free financial education resources designed to help business owners improve and grow their business. You'll find videos, articles, and other resources on topics of interest, many of which can point you into deeper dive resources. It also includes a tool to help develop your own business plan and other resources that can help give you a competitive edge to succeed. You can find the information we've covered today, as well as advanced topics on managing cash flow at wellsfargo.com/business, and click on the business resources at the top of that page. With that, I sincerely appreciate the invitation to speak to you all today, and I hope you found this cash flow conversation helpful for building and growing your small business. Thank you.
Thank you so much, Lauren, for sharing the valuable information with us. I personally enjoyed our conversation and great takeaways from this session. And to our viewers, thank you for tuning in today. We hope you took away some helpful tips for managing cash flow at your business. Please check back at USPAACC.com/events for more business leadership series events coming soon. We hope to see you again. Have a wonderful day, everyone.
Thank you.